Let's take a look at this problem. It's a capital structure problem involving debt and taxes. Acme Storage has a market capitalization of $100 million and debt outstanding of $40 million. Acme plans to maintain the same debt-to-equity ratio in the future. The firm pays an interest rate of 7.5% on its debt, and it has a corporate tax rate of 35%. Okay, Part A asks us this. If Acme's free cash flow is expected to be $7 million next year, and it's also expected to grow at a rate of 3% per year, what's Acme's weighted average cost of capital? Okay, so what we're really asked here is to determine the value of the leveraged firm. And we know the value of the leveraged firm is equal to the value of its equity plus its debt. Okay, if the equity is $100 million and the debt outstanding is $40 million, we know that the value of the leveraged firm is $140. And then we can solve for the weighted average cost of capital using the formula you see in front of you. Take the free cash flow and divide it by the weighted average capital minus growth. So what we know is 140 is equal to 7 divided by weighted average cost of capital minus 3%. And then algebraically we can just solve for the weighted average cost of capital. And when you do that, you'll come up with 8%. Okay, next, Part B says, what's the value of Acme's interest tax shield? All right. Well, pre-tax weighted average cost of capital is given by the formula you see in front of you. Take the weighted average cost of capital, add to it debt divided by equity plus debt times R sub D and the tax rate sub C. And what do we come up with? We take the 8% we already solved for the weighted average cost of capital. That's on a pre-tax basis. And we add in the $40 million of debt divided by equity plus debt, and then we multiply it times the 7.5% interest rate on its debt times the tax rate. When we calculate all of that, we come up with 8.75%. So now to find the value of the firm unlevered, take free cash flow, divide it by pre-tax WACC, or pre-tax weighted average cost of capital minus the growth rate. So 7 minus the 8.75% we just calculated, minus the 3% comes up with $122 million. That's now the value of the firm unlevered. So now the present value of the interest tax shield is the difference between the value levered versus the value unlevered. So 140, which is equity plus debt that we've already covered, minus the value unlevered, 122, gets us $18 million. And that's how we determine the value of Acme's interest tax shield.